Good afternoon, everybody. Thank you for joining us today. So over the next 20 minutes, I want to bring your attention from Singapore to Japan. It's a market that I think for a very long time was seen as a symbol of stagnation, no growth, pretty boring. But after the collapse of the asset bubble in the early 1990s, Japan spent decades dealing with deflation, low growth, basically declining confidence. And for many investors, Japan was a market really to be avoided, or at best to treat tactically rather than having a strategic structural allocation to the market. But something meaningful has started to change over the last 5 years. Japan has quietly been transforming economically, corporately, and structurally. Inflation is coming back, or you could say it's already at a pretty high point. Wages are rising, and companies are now behaving differently. And policymakers are no longer just trying to fight negative rates and deflation at all costs. Now, what these changes have done is translating into strong equity returns. Banks, exporters, they benefited a lot in the early years, and more recently, areas such as AI and defense, they've also helped Japanese equity market push to all-time highs. So for those of you who are invested in Japan, congratulations, that must have been great. But it also raises a very natural question. Where does the market go from here? Can Japan keep this momentum going? Now, in our view, just like any other major economy, Japan does face its fair share of challenges. But it also continues to offer attractive opportunities for investors who are willing to look beyond the headlines, these themes that have been dominated the market over the last few years, and most importantly, the short-term narratives, and instead focusing on fundamentals, valuations, and being more selective about what you invest in Japan. So I would like to break it down into 4 main areas. One, firstly, I'll recap how Japan has reemerged as an attractive equity market, what changed, and why it mattered. Second, I'll compare Japan in a global context to how it's done to the US, to Europe, other major economies and markets. Third, I'll address some of the concerns that have come back into the spotlight recently, so rising bond yields, fiscal policy, Japan's debt levels, and why we believe that while these risks are real, they are manageable. And lastly, I'll end with our thoughts on where opportunities still exist in Japan today, and why we believe a more disciplined, selective investment approach is going to become increasingly important in Japan. Okay, so let's start with how Japan became attractive again. So oftentimes in this section, I like to summarize it by what we call the 3 R's. Reflation, reform, and reallocation. So let's go on reflation first. So as I mentioned, Japan struggled for decades, last 3 decades really. Stagnant prices, no wage growth, no confidence. In that environment, there was very little incentive for households to spend and for companies to invest in capex. So people delay purchases because their cash are eventually worth more in the future. Companies, same thing, and economic growth as a result was very subdued. Now, as I mentioned, this backdrop has started to change over the last few years. Inflation, as you can see, since 2021 has become more persistent mainly because of supply constraints. Labor shortages, as you may have heard, they have become increasingly acute because of demographic challenges. Years of corporate underinvestment has resulted in very low productivity levels, especially when you compare to other OECD economies. And on top of that, the yen has weakened a lot over the last few years. That has also pushed up cost of food, energy, and other imported goods as well. Now, an important thing to note here is that policymakers are now trying to actively manage this inflation rather than just beat it down and fight it entirely. And what I mean by that is there are more nuanced measures that have been introduced to ease these cost pressures, support low-income households, and trying to allow the inflation to stay at a relatively healthy level. Now, on the other side, we have wages which have stayed around 2% or under 2% for most of the last 30 years. That has spiked up to about 5% in 23, and in 24, 25, and early signs suggest that in 2026, it will continue to maintain above 5%. Now, part of this is also because of labor shortage, but also because corporates have been making tons of money, their profits have been great, and there's a lot of government pressure to ask these companies to raise their pay to attract more talent. Now, this combination of higher wages, better, more inflation at a healthy level is very, very important because overall, Japan is moving from a deflationary mindset to a reflationary one. And that shift fundamentally changes people's behavior. When people expect prices and wages to go up, then spending, investments, these decisions, they become more normalized, like it has been in other developed economies over the last 20, 30 years. This behavioral change is going to be essential not only for what has happened in Japan over the last few years, but is important for sustaining economic growth. Now, the second R is reform, which probably is a term that is many of you have heard, is very associated with the Japan story, especially on the corporate side. Of course, the weak yen, as I mentioned, that has helped a lot of Japanese companies, especially exports when they sell overseas, translated back into Japanese yen. But that alone does not explain the improvement in profitability. Now, I'll explain this chart in just a second. But what has really changed is how companies manage their balance sheets, their capital. Over the past decade, they've been under pressure by regulators, shareholders, activist investors to improve their returns on equity, to use their capital more efficiently. So listed companies, for instance, are now expected to disclose very concrete plans on how to improve their price-to-book ratio, the return on equity, or their risk being delisted. Now, this obviously forces a lot of management teams to figure out how to deal with these long-standing inefficiencies that has been in place in the last 2-3 decades. So as a result, if you take a look at the chart here, the gray bar is the ROE levels of companies in 2012, and in 2025, it's marked in red. So you've seen a very broad-based improvement in ROEs across the market over the last 10 to 15 years. It's not just on the large caps, the mega caps that we all hear about. This is extended across sectors and market caps and smaller companies as well. So some of you may wonder and may have heard this story for years now. This probably isn't the first time you've heard this story. So some of you may ask, is this reform momentum going to continue? But I'll give you an anecdote. So the chairman of the Japan Exchange Group, as recently as in June 2025, has stated in an interview that corporate reform is still far from where the regulators want it to be. I'll paraphrase him a little bit, is about 20% of the way there. Now, this tells us, even though 20%, 25%, it could be an approximate number, but this tells us this pressure from regulators, from the government, is going to continue rather than fade away. As investors like us, this ongoing reform is going to remain a powerful structural tailwind for years to come. Okay, so the third R, reallocation. So this is talking about how companies are using their cash. Now, as I mentioned earlier, Japanese firms were hoarding cash, underinvesting, basically keeping cash in their reserves. Now, that made sense when deflation was happening, but it limited shareholder returns, it limited long-term economic growth and corporate growth as well. But if you look at the top right chart here, the corporate capex is now reaching all-time highs and has finally exceeded the levels that we've seen back in the 1980s. And that was when the bubble was happening. Now, companies, because of various reasons, have to invest more in automation, digitalization, and other technologies that would enhance productivity. They just can't escape it. They have to face it because of these structural challenges. But at the same time, if you take a look at the bottom right, you see that there has been a multi-year upward trend in share buybacks. Now, this is just an example of some of the corporate actions that they've done. 24 and 25 especially, we've seen a surge, but if you look at management buyouts, different forms of M&A, unwinding cross-shareholding, some of these things, they've all surged in recent years, and they seem to be continuing to grow, going up. So this suggests that there is still a lot of momentum when it comes to these corporate actions and reallocation of cash. Now, this is a real behavioral shift from preserving cash to deploying this capital to grow and to benefit shareholders. So most importantly, even after spending all this money on growth, on capex, on buybacks, more than half of the TOPIX companies still have net positive cash. Just to give you a reference, if you compare it to the US, it's about 25%. In Europe, that number even goes down to 16%. So that means that there's still more room for further capital reallocation in Japan. Again, this is going to provide a more of a supportive backdrop for equity investors of Japan. Now, so how has all this played out in recent years with all these tailwinds against other markets? In simple terms, This chart here shows the returns in local currency terms between Japan in red, the gray is S&P, and the Europe is in blue. Essentially, it has kept pace with the US, has outperformed Europe. Keeping pace with US, I think in itself could surprise some investors who still associate Japan with low returns. But of course, I mentioned this is in local currency. So if you convert it back to US dollars, for US dollar-based investors, of course, the yen depreciation is going to cause you to earn less from Japan than from US equities over that period. But what this still tells us is that Japan's rally has not been a fluke. It has been supported by earnings growth, reform, changing corporate behavior, not just valuation expansion. So the natural question, given the strong performance that we've seen, isn't Japan starting to get expensive, or is it too late to invest in Japan now? But when we look at valuations, the answer is not necessarily. I'll explain why. So if you take a look at the left-hand side chart here, this shows the price-to-book ratio of various markets. Japan is standing at 1.8 times price-to-book. This compares to 2.4 times in Europe, 3.6 times in global equities, and not to mention 5.5 times in the US. That is a meaningful difference. Now, to give you another perspective, over 30% of companies in the TOPIX 500. So the TOPIX 500 is essentially the 500 largest, most liquid companies in Japan. 30% or over 30% are still trading below book value. In US, that number is at 4%. In Europe, it's a little higher, but still only at 17%. So for investors who are worried about paying too much for opportunities, Japan actually continues to provide a relatively attractive valuation or entry point. But particularly when you consider that Japanese companies over this period of time, their fundamentals have gotten better, they've made more money, and their profitability has been very, very strong. Of course, I wouldn't go as far as saying Japan is cheap, even though, after all, it's gone up 85 to 90% over the past 5 years. So what do I mean by Japan still is attractive? Now, this is where selectivity becomes critical. So let's take a closer look at this chart here. The large cap is, if we break the market down by market caps, large cap is in red, and gray and blue are the mid and small caps. So if you look at historically, large and mid cap are trading at similar price to book levels, and small cap tends to be trading at a lower level. Now, what has happened since 2021 is large cap has surged, as you can see in the red line, while the mid caps and small caps have lagged behind. Now, why is that? Because many global investors have started to pay more attention to Japan since 2021. They're buying Japan through index products in a more passive manner, and a lot of these products are mostly made up of large caps. Now, that as a result, a lot of these large caps, liquid names, they have outperformed, but on the other side, a lot of the smaller companies are relatively overlooked. At the same time, we saw enthusiasm around AI, defense. They pushed valuations in certain industries and companies to pretty stretched levels. So rather than saying that Japan is cheap, I think it's probably more accurate to say that Japan is unevenly priced. Some areas are expensive, but others are still underappreciated. So this is why being active, being more selective in looking at Japan is going to matter more and more than simply buying into an index or trying to capture the Japan story in a passive manner. So I want to spend the next few minutes changing topics, covering some of the macro topics that I think many of you may be pretty aware at this point. So one of the most common questions that we received recently is whether Japan is becoming too aggressive fiscally, monetarily, whether that's going to destabilize the capital market. The new Prime Minister, Takaichi, of course, she's been quite willing to pursue a more fiscally expansionary fiscal industrial monetary policy, invest more in strategic areas such as AI, robotics, shipbuilding, etc., but also trying to help out some of the lower income households from rising living costs. At first, when she first got elected in October, some of you may know, equity markets in Japan went very well. The so-called Takaichi trades pushed equities to new highs. Investors were very hyped up about the prospects of growth in Japan. But since then, we've seen a shift in mentality and sentiment because markets start to worry about whether this approach over time could really worsen Japan's fiscal position. Now, as these concerns grew, Japan's government bond yields, as you've seen, has started to rise in red. The Bank of Japan also raised rates last month. That has also caused yields to go up further. Now, this combination is creating a lot of unease in the market, particularly for investors who are very sensitive to whether they're able to maintain their debt sustainability. So what is important here is not just looking at the market charts, but it's also in looking at how the policymakers have responded. So if you look at the government recent announcement, they've adjusted its upcoming budget to target a primary balance surplus. Now, in simple terms, essentially is that they're trying to increase their tax revenue, but at the same time spend less money. So the tax revenue that they get from corporates, from the citizens, is going to exceed the amount of money that they spend. Now, this is the first time they've tried to do so in the nearly 3 decades. And this is very meaningful because it essentially signals that while growth remains a priority, fiscal discipline has not been abandoned. They're still going to be quite fiscally disciplined, excuse me. So policymakers here seem to be balancing ambition with pragmatism. Now for investors, this highlights something critical. Japan's policy framework is quite adaptive. When the market suggests or pushes back, they will respond accordingly, which in the context of things would help limit this tail risk that some investors are worried about. So let's look at the interest rate quickly. If we look at Japan's recent rate hike, now it's at 75 basis points. But to keep it in perspective, inflation, as I mentioned earlier, is running at almost 3%. So in real terms, it's actually still negative and very accommodative in terms of real interest rates in Japan. So that means that borrowing costs for companies are going to remain low by global standards especially, and the impact on economic activity is going to be limited. At the same time, it's very clear that the Bank of Japan wants to pursue rate normalization over time. They've been in negative rates for 8 years, and there is a need for central bank to manage this rising inflation and the recurrency. And the markets are currently pricing in perhaps 1 or even 2 additional rate hikes this year, which would still leave them far from what we call a tight monetary policy. So turning to debt, again, that's one of the pretty popular subjects with recent news flow. So of course, Japan does have one of the highest debt to GDP ratio at over 200% among developed economies. That is not in dispute. But 2 points are often underappreciated by investors. First, the composition of the debt matters. What does that mean? Who owns the debt? It's mostly by domestic banks, insurers, pension funds, and the central bank itself. So in a sense, it does reduce this refinancing risk and the vulnerability to sudden capital flight. The second point is since COVID, where they had to spend a lot of fiscal stimulus, the trend has actually improved. It started to come down. Now, strong nominal GDP growth, higher inflation, and corporate profits, which then translates to higher tax revenue, that's been helping this debt dynamics. So in other words, the debt to GDP, the GDP part, the denominator, is finally growing again, which helps with the overall equation. Now, crucially, as I mentioned, the government is trying to be more fiscally balanced, which means that policymakers are aware of how sensitive the market is about this issue and are trying to anchor confidence in investors. This, of course, does not necessarily eliminate the risk, but it does reduce the likelihood of this spiraling into a larger crisis. So, last point I want to make here is, with all this macro policy backdrop in mind, where might investors find opportunities in Japan right now? One area that we see is still in automation and robotics. A lot of attention has been in AI, rightfully so, but the structural labor shortages in Japan are unlikely to disappear anytime soon. Companies will continue to invest in automation, and some high-quality business in this space have been overshadowed by all the enthusiasm around AI. What that has done is create valuation gaps that can potentially be captured if market dynamics normalize or if the hype in AI start to subside. Another area is domestic consumption. Now, inflation has weighed on the purchasing power of the public, of citizens and has suppressed demand. But if government measures work and inflation start to come down, what this means is wage growth could potentially turn positive. This can help a lot with stimulating domestic consumption and demand, and this is an area of the market that we believe the market has not started taking account into yet. And finally, as I mentioned, corporate reforms is still an ongoing opportunity set. Capital allocation improvements, M&A, corporate action, this is all going to unlock value. But these will require company-specific and fundamental analysis from the manager. So in short, we do believe that this environment is going to increasingly favor investors who are patient, selective, and focused on fundamentals rather than looking at broad themes. So let me leave you with 4 key takeaways. 1, Japan's economy and corporate sector are going to benefit from these macro drivers. 2, macro and policy risk do exist, but recent actions suggest that they will be managed in a responsible way without abandoning growth objectives. 3, Japan is still attractive in terms of valuation, but knowing what to own is becoming more important. And lastly, focusing on company fundamentals rather than shifting narratives is a more prudent way to invest. So overall, to navigate these uncertainties, a patient, value-focused approach and can help investors avoid overpaying for this excitement and focus instead on long-term sustainable returns. Thank you, everybody.